Hello and welcome to the i3 Insights podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. As you probably know, we love our disclaimers in this industry, so here's ours. The following recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show.
Welcome to the i3 Insights podcast. My name is Daniel Grioli and I'm the Market Fox columnist for i3 Insights. I'd like to give a big thank you to our steadily growing group of listeners. We really enjoy receiving your comments and feedback. Please get in touch by using the contact page on the i3 website. That's www.i3-invest/contact. You can also follow us on Twitter at i3invest and at market_fox. Today I am joined by Alex Waislitz, founder and executive director of Thorney Investment Group. Thorney is the responsible entity of two listed investment companies here in Australia, Thorney Opportunities Limited and Thorney Technologies Limited. Alex is arguably more famous for turning an initial investment of $1.5 million into a $1.39 billion fortune 25 years later. His fortune takes him to number 54 on the BRW Australian Rich List. Alex has an interesting and somewhat unusual set of skills and interests. There aren't many fund managers with deep experience investing in microcap stocks, as an activist investor, a contrarian value investor, and an investor in tech companies. I can't wait to chat with Alex about all these topics and more. So without further ado, Alex Waislitz, welcome to the podcast.
Thank you very much. I'm happy to be here.
Thanks for agreeing to do this. We normally start off asking our guests to tell us a little bit about their background and how they got started in the investment business.
Well, when I was 13, at my birthday, it was a big event, bar mitzvah in the Jewish tradition. A friend of my parents, as a gift, gave me a few BHP shares. And I didn't even know shares existed. I didn't know anything about them. And he took me under his wing and explained a little bit about it. And I was really thrilled when I got my first dividend cheque. And I thought that was great because previously I'd been washing cars and delivering newspapers to earn a few dollars. And this was suddenly just came in the mail. So I thought this is something I need to know more about.
Do you remember what you spent that first dividend cheque on?
I think I did. I bought a bigger bike so I can deliver more newspapers.
Very good. Okay, so that was your introduction to the stock market. How did you start the more formal part of your career?
Well, I studied law and economics at university, but was sort of interested more in the business field and went over eventually to New York, found a job on Wall Street and worked there for about a year and a half, really on more of the sales side across a whole bunch of products in the International Department of Prudential Securities. I realized I preferred to be on the deal instigation side and reached out to an Australian entrepreneur at the time, Australia's first billionaire actually, Robert Holmes-a-Court, and was able to secure a job with him in his fledgling New York office. And I stayed with him for 4 years, learned a lot about the investment side and had a determination to go down that investment path when I returned to my hometown in Melbourne.
Okay, very good. So not all of our listeners might be familiar with Robert Holmes-a-Court and the kinds of deals that he did. Can you tell us a little bit more about what it was like working there?
Yes, it was a thrilling environment. When we opened the New York office, he had about $10 million of assets or investments in the US, was just starting off. But in about 18 months, we had close to $1 billion that we were invested in various companies there, including some resource companies. And I was lucky enough, even though a young member of the team, I think the youngest, to be in the middle of all of that. And so it was a tremendous learning curve. And I was lucky from him. He was both a skilled trader, and indeed he was the leading exponent of the option market in Australia, and he taught me about that, equities. But he was also a very astute investor in his own right on fundamentals of a company, which I learned to utilize in my analysis, and also someone who could pick up on the value of intangible assets or not recognized assets at market values that may be underwritten on book values in balance sheets. He was a great strategist and a great tactician, and I learned also from him, I suppose, to keep your options open and keep your alternative approaches alive. And he was also a very dynamic investor in the sense that he was early activist. He challenged boards, management, strategy of those companies that he invested in, always with an eye of how to extract more value on behalf of shareholders. And I guess I adopted that approach right from the very beginning when I started my investment company.
We'll be asking you a little bit more about that activism a little later in the podcast. So you mentioned that you returned to Australia, and if I'm correct, you received some job offers from two fairly notorious Australian businessmen, Alan Bond and Christopher Skase. What was it like meeting them, and why did you decide to turn those down?
Yes, well, having worked with Holmes Accord, who was the ultimate entrepreneur, I decided that environment was very exciting, very creative, very broad, because they would pursue lots of different opportunities. So when I decided to return to Australia, I reached out to some of the better-known entrepreneurs, and the two that you mentioned were very topical and noticeable, and also they were spreading beyond Australia internationally, which I was sort of interested in keeping alive the opportunity of international exposure and travel. Alan Bond had taken over through his Bond Corp, the former Holmes Accord empire of Bell Group and Bell Resources. So that was the initial reason I had an opportunity to engage with his camp. And Christopher Skase was, expanding through television and hotels and other assets. So amongst other entrepreneurs that I met them. They were both very engaging personalities, very enthusiastic, big vision kind of dreamers, and very dynamic personalities. So you could see why people were attracted to them. And they were global visionaries, I guess. They felt that they could achieve tremendous amounts, and as I said, big dreamers.
Just an interesting coincidence. My office here on Collins Street actually happens to be Christopher Skase's old office. One of the other tenants on the floor has in his office what was the safe that Christopher Skase used, which they had to crack. They had to call somebody in to cut the door open to
find there was nothing in there.
To find there was nothing in there after he'd ran away from Australia. So very interesting. But
yeah, so as I said, I was attracted to entrepreneurs, but in the end, I wanted to be in my hometown of Melbourne, where my family was. So I was trying to identify who was a up-and-coming, successful entrepreneur, businessman. And that's where I reached out to Richard Pratt, who was not only a terrific industrialist through his manufacturing operation, Visi, but at that stage he had a financial services arm that was growing, and that was appealed to me in terms of trying to join him in Melbourne.
Okay. So we'll come on to this subject of Richard Pratt and Thorney Group a little later. First, a question that I like to ask my guests about their early careers. What lessons did you have to learn the hard way?
Well, the first lesson I suppose I learned was when I went to New York. I realized that I wasn't part of the traditional system of entry into Wall Street. And I was, as an outsider, not having gone to the Ivy League schools and the high schools, you had to present not only your academic credentials, but create a narrative around yourself that would encourage people to give you a chance. But that required a fair amount of resilience. That required getting rejected and persevering. So indeed, when I was trying to get the job with Holmes Court, I sent out lots of letters. I lettered to him a cold call letter, and then I just pursued him virtually every day with a phone call and said, well, when are you coming? When can I have an interview? When are you coming? When can I have an interview? And he passed me on to his head of international based in London, and I did the same thing. And eventually, Alan Newman was his name. His PA took pity on me and organized an interview for when I got to, when he arrived in New York. And he said, I don't really know anything about you, and I'm not going to check into your background too much, but because I like your perseverance and your determination. So on that basis alone, I think he virtually gave me the job opportunity.
That's a very interesting story and a good lesson, I guess, for everybody, that you never know when that persistence is going to pay off. So you're now back in Melbourne working with Richard Pratt, an up-and-coming entrepreneur and successful industrialist. How did Thorney Investments get its start?
Well, I maintained my interest in the investment world after New York, and I really spoke to Richard and said, look, I'm very happy to learn some things about the manufacturing operation, and indeed I was working in the corporate head office with him, but I said I'd prefer to spend more time on your financial services arm. And at that stage he also had an insurance company that obviously had an investment management side to the insurance funds. So I was able to split my role between the corporate responsibilities in treasury and finance and overseeing the manufacturing side of the business. But I was able to also spend some time in the investment side of the insurance company, and that's really where my interests laid. And after a period of time, I went to Richard and said, look, I really want to pursue the investment side as a more career-based direction. And even though he wasn't that keen on that, he enabled me to find some early funding. And I started on a part-time basis Thorney while I was still working in the corporate office and learning about manufacturing and industry. So that was in the early 90s.
Okay. So for how long were you running Thorney on a part-time basis?
For a couple of years, and before I got first full-time employee, and I committed myself to more time there. But initially I was running it out of the corporate office of Visi, and that was terrific because through Richard, a genuine industrialist, and I would argue perhaps Australia's greatest industrialist, I really learned a lot about day-to-day business, about strategic planning, importance of cash flow, leadership, visiting physical locations, capital management, many lessons that I learned in following Richard around, and many discussions with him and his key executives. Again, even though I was pretty young, I was able to get some terrific insights which have stayed with me all the way through, and has enabled me to look with a lot greater depth at companies than I think most fund managers have ever had to experience, because I was really close to the physical operations of the manufacturing enterprise.
So it sounds like you think the investment side and the business side are really two sides of the same coin.
It is very much to me. I've always said I love the business of business. I don't. I like the growth plans, expansion, the dynamics of it, the hard decision making that's required, which I learned from Richard in when things are going wrong, to be able to cut your losses, to be able to pivot, but to keep the ship moving forward, so to speak, take the knocks. Something goes wrong, you lose a customer, for example, a machine breaks down, for example. What are your crisis management plans when all of these things happen? Those were invaluable lessons, and I think about them still every day in the context of investing. So to me, understanding the business is paramount to investing. I'm not really someone who watches the screen all day and looks for the prices moving fractionally during the course of the day. I'm more interested in the bigger picture and the opportunity for long-term value to come out of an enterprise. So that's why we're comfortable investing in private companies as well as in public companies, because I've had exposure to both. But to me, exactly as you said, I believe they're one and the same experience in investing in the business and investing through equity into the shares. And quite often we invest through convertible notes or other loan instruments because it's really the same assessing the risk and opportunity relating to a business.
So you've started Thorney, you're working on a part-time basis. Did you ever, in your wildest dreams, and I know there's a bit of hindsight factored into this question, did you ever envisage that it would become what it is today?
Absolutely not.
What did you think it would be?
I was around people, fortunately, like Richard, who always used to say, if you dream big, you can achieve big. If you dream small, you will achieve small. Holmes Accord was also another big believer that he could do things. I didn't have that degree of self-confidence that those entrepreneurs had. And maybe they didn't at the same age. I'm not sure. I was just still in my younger years. But I did have a strong sense of self-belief. And I also learned from my parents, who were refugees, the value of both hard work and never giving in and having a go. So I thought with that initial 1.15 million that I was loaned, if I could turn that into 2 million, that would be extraordinary. And once we got, actually, I ended up turning that into 4 million in year one. And I thought I sort of couldn't really believe it, actually. And it was like an enormous amount of money to me. And I sort of was taken aback by that. And I really said to myself, gee, I've got to try and do this for a second year to convince myself that it's real, which I did. The 4 then turned into, I think, 7 or 7.25. And I think by the end of those 2 part-time years, I felt enough confidence that we could achieve something else. And partway through, I said, oh my God, if we could get to 10 million, that would be incredible. But I never envisaged that we would get to tens or even hundreds of millions, and exceeding $1 billion never became in my thoughts until many years later on the journey.
That's a great story. I feel like I have to ask, what did you do to turn 1 million into 4?
Well, I was doing something which actually wasn't. I realized that I was good at, but it wasn't something that I was actually my preferred way of going. I was trading actively, and I was using some leverage of options, which I'd learned from Holmes Accord. And what I liked about that was it was quick, and you got a tangible result one way or the other. What I didn't like about it is I wasn't getting close enough to the businesses that I was investing in. And so even though I was successful, I didn't like that as a lifestyle choice. I liked, from the experience of Visi, getting closer to the operation. So I actually pivoted once we got a bit further down the line and started to shift to microcap investing, because I still didn't have a lot of enough money to play in the large caps or the mid caps in a meaningful or strategic way. So at the micro caps, you could put a few $100,000 to work, and you could buy a stake, and you could build up to a substantial stake where you could start to have a dialogue with the executives or the board members and really get more involved in the strategic direction and the tactics they were employing, and really get to know the operation and see whether you felt this is something that could actually exceed expectations and really outperform. So that was a change of approach, but it was much more closer to what I was interested in from a lifestyle point of view, and also a stimulating and intellectual kind of pursuit. And in doing so, I realized that it suited my personality to be across all industries, because I love learning. I love seeing different businesses and different enterprises, how they're going, and seeing what I can learn from one business, one industry, and take it to another industry. And I didn't think there was a lot of people doing that, so I thought that's terrific, rather than be super specialist just in one area or another. So I still do find it very intellectually stimulating going across those kind of verticals.
And that leads me to my next question, which is about the two listed investment companies that you manage, Thorney Opportunities and Thorney Tech.
Yes.
And on the surface, those two companies may seem quite different, because one is the Opportunities Fund is investing in businesses that have been running for a long time, in most cases, fairly stable industries, not too much change perhaps, or opportunities where you have the opportunity to do something on the activist side, whereas the tech listed investment company is very much about new businesses and new ideas. And there aren't too many fund managers that would manage both. Typically, fund managers tend to stick to one thing. So how do you mentioned this love of learning and this interest in the business of business. How do you switch between the two funds? And perhaps first you can tell us a little bit more about both investment companies.
Yeah, happy to do that. And it is, and the reason we created two different vehicles is they are two different investment experiences and two different type of risk-reward scenarios around it. But in relation to activism, activism has become a sort of popular term really in the last 5 or 10 years, and specific activist funds that have emerged. But I would argue that we were sort of activists in a non-hostile way right from the very beginning, as I talked about with those small caps. I call it constructivism, which is sort of pushing or engaging in debate for constructive change. And most of the time, we've achieved good discussions with management without any hostility, just a question of discussing different approaches and what could be a more effective rate of return, could be a more effective outcome, could be helping to make a tougher decision on divesting of a business or closing down of a business with the support of a major shareholder, to the management in making a tough call that might require write-offs or things along those lines. But I've also always been interested in innovation, and I noticed again with Richard Pratt that he was always in an old-fashioned business, if you like, paper making and box making and recycling. He was always going overseas, looking for what was new technology, new initiatives, and so on. So my mind was open to changes, seeing what new technologies were all about, and embracing them where it made sense. But what's common about both of those things, those companies, is that we're really, for the most part, backers of people and individuals who have got passion, skill, knowledge, a can-do attitude, and usually those who have got their own money alongside other shareholders, so there's an alignment of interests. Those tech entrepreneurs, and as well as more old-fashioned, if you like, or non-tech companies, that's a commonality across all of them, and that's what we like to support. Tech investing, we've done it. We've been doing it for many, many years in Australia, supporting it in the medical space, and companies that were creating their own experience. Many of them sort of an Australian version of an overseas experience that had already had a few years of trial and error or success. So to be able to, for us to be confident that it was a path that not proven yet in Australia, but indeed was forged perhaps earlier on overseas. And for example, a company like Webjet that we were a supporter for more than 10 years ago, and we're still a shareholder there, they sort of had an online model where people engage and get a marketplace of pricing on different offerings from the airlines and subsequently hotels. And people always questioning, well, why would someone go to that and pay a fee where you can go to Qantas's website yourself or to Virgin or whatever? But we noticed from overseas that there was a stickiness to it, and if you created a brand which had integrity and good service and trust, then people would come back and they don't mind paying a small fee for that knowledge. So we had identified that, and whereas most people were skeptical, we embraced it and became big shareholder in the company with terrific leadership and management, which it still has today, has delivered. And those shares have gone from, I think, 15 or 20 cents to $13 today, and it's been a terrific journey for us. So we're not scared of new ideas. We're not scared of new approaches, but they're not necessarily always overnight successes, and they take time to come through. And that's why the risks are different to Thorney Opportunities. Thorney Opportunities was playing to our strength of many, many years of experience in being a constructivist, being involved in recapitalizing and turning around companies that have faltered or wavered for one reason or another. We're very comfortable in that field. Personally, I enjoy the challenge of trying to restore something that has gone wrong. And we believe we can offer a lot of skills and experience and network of people as well as capital to help a company get back on the right path.
You've given us a few hints in your responses as to your investment philosophy. This focus on people, the focus on the business itself and its ability to generate cash, and understanding the operations and how you can perhaps work in a constructive way with companies to help them improve their operations. Just wondering if you could tell us a little bit more specifically, perhaps, or in a bit more detail, what is your investment philosophy?
The investment philosophy, I suppose, is how do we make mid and long-term returns on an absolute basis that is worthwhile the effort of investing. And the approach is pretty simple. You first of all try to base all our investing on what I would call a sort of a value proposition. And that is to get in at a price that is attractive from a risk-reward basis that we think will create good alpha. We're not generally investing to make 5% or even 10%. We're trying to outperform that, and also trying to identify companies that, if they get the elements that we like correct, which is the business strategy, the management, executive team, the strong, constructive, supportive, strategic board of directors led by the appropriate chairman. They have the right culture in the organization. We're looking for these type of companies so that we can stay with them for multiple years as an investor, and not so much as a trader or flipping the position. And that is important, particularly when you're talking about micro caps or mid-cap, smaller mid-cap companies, because particularly if you take a strategic stake, there's not a tremendous amount of liquidity. You can't borrow against it aggressively. So you really want to make sure you're on the right track for multiple years, and progressively you can exit over time. But actually, a lot of our exits have come through M&A activity as companies have grown, shown expansion paths, and have become more attractive to a bigger company, perhaps with a bigger balance sheet, who can go on that journey a little bit faster because they can leverage the position. So we're looking for things that can go up for an extended period of time. So our philosophy is still to back management, and and then the business. But in some situations, we find the business is good, but the management is not so good, and then we try to be part of orchestrating a change of leadership so that the appropriate management can get the business back on track. So we look for value, we look for people, we look for the the moats around the business, to use a Warren Buffett term. What is the protection against competitors? And try to understand the threats relating to that. We try to look at businesses that have sufficient profit margin so that if things perform, if the business performs, it will be profitable. Those that potentially can pay dividends down the track, if they're not already. Those that are not overgeared, so that they have enough buffer zone if the market's turned against them or the economy turns against them. And usually ones where we can see expansion possibilities through acquisition or through product launches or other things along those lines. Those are some of the things we look for as part of our philosophy of identifying value and growth.
So you mentioned that you're not looking for 5 or 10% return plays. Do you have a target level of return in mind, or are you looking for an upside-downside asymmetry? You hear some investors talk about looking for opportunities where they see an upside that's 3 or 4 times what they see the downside. And how does valuation feature in all of this? So you mentioned you're looking for value. Does that mean that you're using detailed valuation techniques, or is it more of a back of the envelope trying to think where this could get to a few years out kind of exercise?
Well, it's a little bit different in Thorney Opportunities to Thorney Technology from that point of view. In the technology space, there's a real trade-off that you have to deal with, which is often companies have got no revenue or very little revenue. Most of them are not profitable. Most of them in the early days are burning cash, negative cash flow. But there's a vision and there's a position, and they're trying to attract in a very fast-changing world. So to assess value there is a lot harder than in traditional type of companies, say a manufacturing company. So you have to have a slightly different mindset in looking at that. You can take a lot of leads from overseas companies which have created terrific value out of companies even still not making money because of its blue sky potential. And if you believe ultimately in their potential for them to have market penetration and that they can turn the traffic that is going through their site or their app or their particular innovative technology, and you believe in their revenue model that ultimately revenue will come through, those are some of the key factor points to go in. But in those companies, you're certainly not looking for 5 or 10% because the reward has to be higher because of the risks associated with those earlier stage businesses. So in those companies, we're looking to make multiples on our money because there is a risk that new technology will come and outposition them, and that many things will occur on the way through before revenue starts actually translating into a meaningful way. So the risk is high, and we might often face scenarios where we're saying the risk is maybe 20% or 50% or something like that, or even they might even go out of business altogether if they can't raise sufficient money. So you want to know that you can make 3 or 4 or 5 times your money in that situation. And you have to, of course, have a sort of a portfolio approach when you're dealing with tech companies because of those risk characteristics. So, and that's what we've done at Thorney Technologies. We've spread the investment portfolio at the moment across, first of all, listed companies, pre-IPO companies, earlier stage companies. And we've also spread within those categories a number of investments. So we're giving ourselves an opportunity for any one of the investments to outperform, but we're also saying, some things could go wrong on the journey, and we're making sure that none of those things that go wrong could affect the overall stability and opportunity of Thorney Technologies to perform over time.
You mentioned the importance of diversification there. and you're obviously investing in areas where there aren't really market benchmarks, and even if they were, I get the impression you're not the kind of investor that's too interested in what market weight of a stock is in constructing your portfolio. How do you determine position sizes? So you've looked at the risk reward. How do you decide whether you're putting 1% of the fund, 2% or whatever into an opportunity?
Well, that's a good question. When we went out to investors and sought the mandates for both Thorney Opportunities and Thorney Technologies, we were quite clear in saying that we would not be doing exactly what a traditional fund manager would do, who are generally benchmark against one index or another and are focused on just trying to outperform that index. That way, if they do that consistently, they will retain their funds under management. I said, first of all, I'm going to be investing a significant amount of my wealth alongside you, and I'm interested in absolute performance. That differentiates us quite a lot already. Secondly, I said to people as part of that mandate, we will be prepared to overweight in certain investment positions when we think it's appropriate to do so. So what does it mean appropriate? It means where we think there's superior chance for alpha to come out of that situation. And for example, in Thorney Opportunities, we went overweight in a company called ServiceStream, which we were part of the recapitalization. A great management team, which we believed in. Always been a good business, but they had one bad operating division, which is a relatively new one. Once they cut that division, they went back to their core business, focused on it, and their leadership and management skills came out consistently. I think they've had 9 growth halves in a row now, restored their balance sheet and in good shape. Now, we're in an overweight position. It has been virtually all the way through Thorney Opportunities 3 years, and it still remains overweight, but it's consistently performed for us. So, again, if you listen to Warren Buffett, he would say, why would you change a winning situation just for the sake of turning over the money? If you've got characteristics of outperformance, return on capital is good, return on equity is good, the growth potential is still there, led by a good team who have skin in the game, there's no need to change it just for the sake of proper weighting per se. And that's our belief. It's very hard to find those characteristics all coming together for a company. So when they do come together, our view is to stick with it. And in many situations, I think individuals and fund managers cut their profits too early, actually, instead of letting them run when they've got all the things in place that it's likely to run, more likely than it won't run further. So stick with something that's good and take the opportunity. So that's on the one hand. On the other hand, we won't let it get to a ridiculous overweighting where something could jeopardize it. So, we might let a position be 20% of the fund of the pool of capital, or maybe 25%. We wouldn't let it get to 75% and have that correlation too dramatic in that sense. So, but we will never be sort of conventional in the standard sort of fund management approach, and I think that's hopefully over time that will be reflected in our performance. I think when you talked also before about valuation metrics, for me, I'm more a back of the envelope type of person to see the bigger picture and top down. However, the investment managers in the office, I require them to work bottoms up, and so the two hopefully should meet with roughly the same approach to the future. So in other words, I will go more intuitively with the basic number assessment and a view on the team and the approach of the strategy. Our wider team will make sure that the full valuation metrics will be analysed and monitored constantly on the journey of our investment with that company. So hopefully we've covered things on a comprehensive basis.
Just a little further on this point of diversification, how many stocks do you think are enough to diversify a portfolio? Because you mentioned these opportunities where everything comes together are quite hard to find.
Yes.
So I can imagine you're not running large portfolios with...
Well, we have a wide, as I said, the nature of technology and the risks there require us to have a wider group of companies. So I think including unlisted, we probably have 50 investments in Thorney Technologies at the moment, and not only are they spread across the categories I mentioned earlier, which are mature listed, immature listed, pre-IPO, earlier stage, we're also diversifying across geographies. So we have a number of investments in the United States, a number of investments in Israel, both who are leaders in technology. They also give us insights into comparatives in Australia in the same segments. So that's a broader group of companies. Thorney Opportunities, by its nature, is more concentrated. So we will have less positions, and we will try to be in a more detailed way on top of those situations, some of which require activism and more dynamic, engaged involvement from us at a particular point in time. So that's quite resource intensive, so we can't have that many anyway to do the job effectively.
You've mentioned earlier in our conversation that sometimes investment opportunity takes time to prove out. And particularly in the case of Thorney Opportunities, you're often involved in turning around companies. And I'm guessing there's a considerable amount of uncertainty around whether the turnaround strategy will work or not. What do you do with a stock that keeps underperforming? Do you stick with it? Do you cut your losses? Do you buy more? And how do you make that assessment?
Well, we've done all of that. In approaching those things, we've cut our losses, we've averaged down, we've taken time to allow some things to develop and see if what we're being told is in fact coming through. And in some cases we've been very aggressively active in creating change when we see things are not coming through as promised. Look, each situation we make an individual assessment on, depending on our view, and if the circumstances change, we might change our mind. If we believe our investment thesis from the beginning is still correct, but the company hasn't been able to execute on it, or moved quick enough, or have spent too much money in getting there. In other words, management deficiencies, or executive inefficiencies, or lack of decisive decision making quick enough, is different to whether the assets or the business model might be good or bad. So we have to assess all those things constantly. Investing, people need to realize investing is it's a living organism. Thorney Opportunities, Thorney Technologies are living and breathing every day, in my view, and they are affected by many things, the external global issues, and of course their internal own micro world that they live in. So we've got to work out, is it an external factor that's affecting the company, like geopolitical risk, a big financial risk, a currency risk, an interest rate risk, a financing risk, or is it, again, getting back to management decisions that are not leading the company well enough? And have they overpaid for something? Should they have taken an opportunity that they missed out on? So all of these things change every day, but we want to know if the overall strategy is right and the thematic is right. If we're comfortable with that, then usually we will stay and work hard, average down, and battle on. If we think we've got it wrong in our original assessment, not understanding the industry dynamics it might be in, then we may well cut and take our losses and move on. Not happily, I don't like taking losses, but if it makes sense to do so in the bigger scheme of things, then we will do that.
Okay. Well, thanks for taking us through your investment philosophy. Perhaps we'll ask a few quick questions about some of the specific areas, microcap, the activist investing, and technology. Starting with microcaps, do you think microcap stocks are as risky as many people believe?
I don't actually. I don't think they're well understood, and in many cases they're not well analysed, and they're not covered well by the financial press or the investment houses. Probably in the investment houses, it's not worth the time of the analysts to be engaged in small companies because there's not enough flow of business for them. And actually, I really like that because if it's not on people's radar generally, then we can hopefully find or uncover some of those gems. Now, many companies have been successful private companies operating well, and they've transitioned into a public company environment, usually to raise more capital for expansion or to create an exit event maybe for the family or the founder who have involved, if it's a next generation kind of timing issue. So many of them have been successful businesses though, and so the risk associated with their actual business is not necessarily high. The companies may not be experienced in public company domain, and there's some risks that they will mess up from that point of view in terms of how they report their earnings or their narrative around the company, maybe not until they mature into a public company. So those companies, I think, are not necessarily risky at all. They just continue with a good business. There are, of course, many startups and newer businesses which might have a higher risk in that category. So I don't agree that all small cap or micro cap companies are inherently risky themselves. They are illiquid, as I said earlier, so you have to have a high conviction when you go into those companies that you want to really be there for an extended journey, or else you shouldn't take such a big position in it. Take a small position and then you can work your way out of it much easier. So those are some of the characteristics of microcaps, and we, as I said, started off very much in microcaps. We're still active in them, but as we've become bigger and need to deploy more capital, we've moved into the larger end of the microcaps or the smaller end of the mid-caps, and indeed we're active in some companies that are $1 billion plus, such as recently with Fairfax that we've been an active investor in.
We'll come to Fairfax a little bit later on when we discuss activist investing. When I was working as a multi-manager, portfolio manager, I would often allocate to microcap strategies, and there was considerable debate amongst some of the fund managers about how much money you could run in the space before it would start to impact performance. And I'd be interested to know your thoughts on how much money could reasonably be managed in a microcap portfolio before it starts to impact your ability to outperform.
Well, I think microcaps enable you, in fact, to outperform. There's high alpha in them if they get right. But as I said, not necessarily a lot of liquidity. What we've done in that regard is just make sure we're not fully in microcaps. And as I said, we've moved up the market cap scales into our higher value propositions. But I think certainly, I think you're comfortably managing at least $500 million. I think you could put into microcaps. But again, depends on what your definition of microcap is. I mean, it used to be companies of less than 20 million. Now it could be 50 or 100 or 200 million. So it depends on how rigid you want to be in your definition of those companies. But it is an issue if you need liquidity as a fund because of redemptions. Now, one of the reasons that we set up as a listed investment company is that it is permanent capital. So the money stays in the company for the purpose of investing. So we don't mind that it's locked up. In that sense, we don't have to sell out in order to fund a redemption. If people don't like the performance or what we're investing in, they can buy or indeed sell their shares on any particular day. And that's the individual investor's choice. But to have a fully invested microcap strategy where you're at risk of redemptions in an environment where there's not a lot of liquidity is quite challenging. That's true.
I think that's an important point, that you've aligned the duration of your investor capital with the duration of your investment opportunity, so that you've got the staying power in some of these smaller stocks. You're able to deal with the illiquidity that comes with that part of the market. So moving on to activist investing now. You mentioned Fairfax. What interested you in Fairfax? And for listeners that may not know, Fairfax is an Australian newspaper, and traditional news media has been challenged around the world in terms of the growth of online media and alternative media sources, such as podcasts and blogs. Why did you decide to take a look at Fairfax and invest?
Well, Fairfax, as you said, was a traditional media powerhouse in Australia, and indeed I think its market cap at one stage was in excess of $10 billion, and it controlled the advertising pipelines of employment and car sales and real estate. It was a company that failed to adapt to the changing technology world and was relatively inactive in this space for almost a decade while the world changed around them. And progressively, its valuation came down as its earnings came down. And we came to our attention when its market cap had fallen to something like $600 or $700 million about 3 or 4 years ago, maybe. Now, it was still generating quite a bit of EBITDA, despite it the direction being down. But and it was representing a very cheap multiple of that EBITDA, and it still had some arguably very good brand names and publications, and a lot of large overhead and operating cost structures. So our view was that management who were focused on change and looking at adopting new technology and properly addressing the challenges of the business in terms of its expenses, moving the traditional physical subscriber base to an online subscriber base, selling off some assets that were non-core, could represent a big turnaround in the approach to this company. And we'd seen it again overseas with some of the publications who have adapted with basically new leadership. So we felt that a focused leadership could turn around the fortunes of this company, as I said, after they were generally dormant for 10 years. And that's why we started to invest in the shares at that time. But in conjunction with investing, we were becoming more vocal in our view to management and to the board that they should get on with the tasks at hand, and they had to take out a lot of costs. They had to reduce their physical locations. They had to change the nature of their printing presses to adapt to the smaller, narrower kind of papers that were emerging. They had to invest in their platforms to enable digital subscriber base to be engaged. And they started to do that. And indeed, they started to sell off some assets. In their case, they had a big investment in a company called Trappings in New Zealand. And in liberating the money from some non-core assets, they were able to fund the cost of reducing employment numbers, and while still retaining a fairly robust balance sheet. So that excited us, that potential, and that's played out pretty well for us because the shares have gone from around 25 or 30 cents, I think, which was the low end, and I think $1.10 with the combined value of its spin-off company and the parent company.
I'm guessing that going through that process with Fairfax would have taught you a lot about traditional media and also digital media. What do you think is the future for traditional media? Does it survive?
Look, I think time will tell. Obviously, I think we've seen a sort of a leveling off now to a more normalized situation for the time being. which is a greatly reduced number of physical papers, but not a disappearance altogether. There is still people who like the physical format, and that will probably change over the course of another 10 years as the generation who likes to touch and feel the newspapers, move on. Obviously, more and more people are online, and that is the trend. So the likely outcome is that at a point in time, we'll probably won't have papers, and it might come in stages. You might find that the midweek papers disappear first, and people who have more time on the weekend may still enjoy the time to read a hard copy paper. But if you look forward 10 or 20 years, you'd have to say that it'd probably disappear altogether. But I'm not sure, but I think the trend will be in that direction in any event.
So the papers may disappear, but the masthead may survive in some form.
Yes, I think the masthead has still got integrity, and it's still got value, and indeed can be internationalized and pushed in certain other directions. So I think they have to protect that. They have to protect the journalistic integrity, and I think that model is changing as we go along. They have to be conscious to protect that and indeed invest in it to make sure that it does survive and there is value.
But isn't that hard? Because you mentioned that they've been having to cut costs, and I see a lot of traditional news media that's now moving online they seem to be relying more and more on contributing articles and articles from people other than staff.
Yes, well, I think that's part of the changing world. The company had to take out costs. They weren't all in the journalistic side of things. They were in the sort of behind-the-scenes production side, if you like, to a big extent. I think the quality journalists, or the journalists who attract media attention, will probably not only survive, but they'll probably flourish because their ability to distribute their work is wider now, and you can compile your own newspaper now from journalists all over the world, if you like, and you have to subscribe to certain access points to do that. But in theory, you can create your own tailor-made newspaper, and I think that may be part of what happens in the future. But those journalists with integrity, those journalists who can still attract viewers, I think the value of them, the commercial value of them, will go up. They will be able to charge differently for different content. So in one form or another, people will still want to get news, both in-depth journalism, in-depth editorial comments, and more social news. But it all, that's a view on the future. I'm not an expert in the field, but what we did identify was, again, that there was value in an asset, even though the market cap had gone down from its previous glory. We thought there was a turnaround story in there with a more focused management, making some tougher decisions. And they've made a lot of decisions along those lines. They've still got more decisions to make. But certainly the market has respected what they have done, and the share price has bounced back from its lows. And that's what we look at when we look at some of these turnaround or activist kind of situations. We want to look for... There's no point in activism for the sake of activism. You have to have activism with an outcome in mind to get people who are more focused on ultimately creating shareholder value. That's what we're interested in. We're a shareholder. I believe in the ownership of the company is through its shareholders, and management and the board should be respectful of that ownership and really work to align their interests to the shareholder outcomes, as well as protecting other stakeholders in the organization.
So moving on to technology companies. What's more important, the idea, the technology, or the people?
I think they're both important. We're backers of people as a first filtering point for us when we look at an investment. But with technology, you have to have the clear vision. You have to have a purpose or direction that you really think you can penetrate, because usually you're trying to disrupt something and you're challenging an existing way of doing business. So there has to be a pretty big vision. There has to be the ability to deliver on that has to be sort of clear. It's expensive to challenge and disrupt something. Those you're disrupting are defending as vigorously as they can. So it's not an easy playing field, but it's a very exciting playing field.
I saw a chart this morning that was showing the number of IPOs in the US that have no revenue. And it's spiked recently to levels seen usually around the time of a financial crisis. And that brought to mind a question about how do you think about the tech companies that you look at in terms of viability? How do you distinguish between a company that's viable and not viable? Because in most cases, as you said earlier, they have no earnings yet. So you've obviously got to look at other things.
Yes, look, I mean, you've got to do your research into the opportunity that a company is portraying that it can penetrate. How many other players are in that trying to do the same thing? Are there those that are ahead of you, and why are they ahead, and what's their technology offering? What's their revenue offering? Or are you sort of the leader in the field of change? So there's a lot of objective analysis to do, and there's a lot of subjective analysis to do that is difficult. I mean, I think investing it's an art and it's a science, so you have to balance the two. The ability to invest in the future is not for all investors. That is, some investors just want a dividend yield, and that's what they're happy with, and they want certainty, and they don't want to take too much risk, and that's fine. And they are the people who wouldn't have invested in Amazon. They're the people who wouldn't have invested in Google or Apple or some of the companies that are now monster companies that have really been created in the last decade or thereabouts. And there are those new monster companies that are out there and being, at the edge of our fingers, on our fingertips. Now, you can avoid this sector altogether and miss out on what's clearly happening, which is disruption. Now, why is disruption happening at such a rate of speed? Is because we've advanced in the scientific application of technology. We do have opportunities through machine learning, advanced technology like that, robotics, much faster computer power, which is enabling algorithms to process much more quickly large data. So the tools to enable technology companies to move forward are out there now and much more available. So disruption, change, innovation is in a way never been easier in mankind's probably history, and will have a profound impact, and it's going to affect many industries, and people are both scared of them, and people are looking forward to the opportunity for them. So we have to work our way through that environment. It's a difficult environment. It's not for everybody, and you have to have skills, and you have to tap into other skills. And that's why we have partnerships with people in Silicon Valley or in San Francisco and in Israel and other centers of excellence in this field, so that we can make a sensible international-based assessment of the opportunity. And that's what we're trying to do.
A big part of the opportunity with a lot of these tech companies revolves around the user and various ways of estimating the value of a user. Do users have value, and how do you think about estimating what they're worth?
Look, I think users definitely have value. You'd rather have more traffic going through your app or whatever it is that you're putting forward. The ability to monetize the users is the second question. First, get the users and get the traffic. Different companies have different models to monetize. You have to be comfortable that that model makes sense from a user experience point of view as an individual or an organization. Some will and some won't translate into revenue, and you can see other precedents. There are already a lot of companies that are in the process of monetizing eyeballs or users. Which of those models are working? Why are they working? And what's the relevance to the particular company you're looking at? That's part of the assessment. They definitely have value. How much value is it will come out as part of that assessment.
Do you think the problem for a lot of startups is that their cost to get the user exceeds the value that user might have?
I think that is proven to be the case in many companies, and that's a flawed business model, obviously. Even though it offers excitement and on the face value potential, companies have fallen over for that reason. And if they haven't been able to pivot their revenue model or change their revenue model sufficiently, or lower the cost of acquiring a user, then they'll probably go out of business or suck in a lot more capital without the appropriate outcome. We have to be careful of that. We have to look carefully and make our quality judgment with its best information that we can assess on those type of situations.
It seems to me that a lot of internet users have been making a Faustian bargain with a lot of the providers of apps and software. Facebook comes to mind, in that they're happy to share their personal data for free, knowing that they're being sold targeted advertising and other things, because they've valued the benefits of being on the app as being more important than the personal information they've given up.
Yeah.
That seems to be changing somewhat now that people are discovering more about what these companies are doing with that information. Is that something that you're tracking, and do you think that has the ability to, or carries the risk that it might disturb some of the business models of the incumbents?
I think clearly with most recently the issue with Facebook, the issue of privacy, the issue of access to data has become a lot more topical, and indeed I think Congress are investigating it, and it is a real turning point with people in the world that the world that technology has led us to at the moment, the access to data and the use of data. I think there will be more governance through legislation about managing this exposure. But ultimately, I don't think that will stop the progress of technology and use of information for analytics and predictive behavior and things along those lines. But there'll be more awareness and more probably disclosures around it. People will be able to opt out, but at the end of the day, I don't know how many will opt out. People will be able to charge for their data and the information or get some sort of rebate back. And I think that'll still need to be determined what is the commercial value relating to that. But I think you're right, there is a changing sentiment at the moment which will translate to some degree of change.
It's all very interesting, and I'm sure you'll be looking keenly to see how it plays out. Given your experience investing with a whole range of tech startups, what advice would you give startup investors looking for capital in terms of how they interact with people like you?
Well, I think they have to be as transparent as they can with their strengths and weaknesses. They have to demonstrate an ability to pivot if something goes wrong, because inevitably it does. So whilst they have to be passionate, they have to get a sense that those entrepreneurs are fast on their feet as well and flexible in their thinking. I would say most of them should be more modest in their valuation expectations as they're starting off, and often they should raise more capital than they think they need, because generally it takes longer to penetrate a market than their optimistic assumptions usually will have in their model, and it usually costs more to get to that point. So from our point of view, we would prefer lower entry points, more capital as a buffer zone. Mind you, that requires also a conviction of us that they will be respectful of the cash and not burn it too quickly, even if they raise more. So we want to know there's good disciplines around the application of that cash. And we don't have any problems if they build in some optionality or upside on achievements of success. So even if they lower the valuation and dilute themselves a bit more aggressively at the beginning, they can catch up later on if they actually achieve their outcomes that the investor group hope that they will achieve. So that would be sort of our approach. And if it's a sort of inverted commas a crazy valuation, then we're not likely to participate. If the hockey stick that they're presenting is too extreme, then we will back off and say there's other opportunities to look at. And maybe we'll miss out on a few opportunities in that regard, but we also won't jeopardize the overall Thorney technologies by chasing too hard something that is too much of a blue sky dream.
I think that's some great advice for startups there. So wrapping up our conversation, you've been really generous with your time in telling us about what you do and how you think about investing. I've got to ask you the tough question. What have been some of your best and your worst investments? We always love hearing about the worst on the podcast.
Yeah, well, I think I would say that we've been doing this for 25 years and we're still learning every day, and we make mistakes. But fortunately, the wins we've had far outnumber in number the mistakes we've made, and also far outnumber in dollars the mistakes we've made. That's not to say we won't keep making mistakes and errors, and some of the errors may be absolute in terms of companies just won't recover, and others may be more, you'll have a lower IRR because things will take longer, but they'll still come through over time, but may not in the time frame that you hoped. So some of the worst mistakes we've made, there was a company called Hasty that we invested in a number of years ago. It was a sort of engineering construction services company. Why was it a mistake? It was a mistake from Thorney's point of view. We relied too much on one investment manager without having a countervailing or counterbalancing other views on the investment. And we've addressed that by having multiple people now on larger investments. That had a number of overseas investments that we didn't either visit or understand the risk relating to that well enough. So we lost money on that investment, enough to that we were angry about, and I was frankly, if I can say, pissed off about, but not enough that affected the overall growth of Thorney. But it was still a reminder to us that you've got to do your due diligence, you've got to probe deeper and wider, and if it is something that a company that has overseas operations, be at risk, that you may not know what happens in some of those subsidiaries, especially in complicated domains, such as in that case was in the Middle East, where they just weren't being paid on some of the receivables, for example. So that was one that we weren't particularly happy about, and we take that on the chin. In terms of success, as I mentioned, Webjet just recently, a great success for us, which is in Thorney Opportunities, a company called ServiceStream, which we helped recapitalize at around 20 cents a share, probably 4 or 5 years ago. The shares are trading at around $1.60 today. They're paying dividends again. I think we're up, we've made 6 or 7 times our money, 600 or 700% on our money there. And it was just helping that company get its balance sheet right and help that company restore its integrity with the banking community and help that company go back to its core business and focus intently on that was what we played a role in, and making sure that the leadership of the company, from the chairman to the board to the chief executive and chief financial officer, were functioning well with a common strategy and a common goal and executing on the strategy. And that's what happened, and it's been a great success for us.
That's a great story. You've been kind enough to tell us about some of your mistakes. I'm interested to also know what you think mistakes investors make more generally. What do you think are some of the biggest mistakes investors make?
I think the biggest mistake from speaking to investors that I've seen is investors don't understand the risk that each individual investment they're making could comprise of, and they don't build into their investment enough thought about the risk they're taking on and a strategy about mitigating that risk. And perhaps they go all in on something. They maybe borrow to go into something, and if something goes wrong and they get a margin call, for example, they don't have enough wherewithal, other resources to hang in there, and they're forced then to sell at the wrong time. So I think understanding risks and exposure is important. Portfolio construction as part of that is something that I don't think a lot of people understand. And the other side of the equation is I think people ride their losses for too long instead of cutting their losses, and they cut their profits too quickly instead of riding them to further upside.
That's a classic problem, and in the behavioural finance literature, it's known as the disposition effect. It's something I've written about several times on my blog, and it's a very hard behaviour to fight, but an important one to try and bring under control.
So I would recommend to all the readers that they, in fact, do read, that they absorb as much information they can. Anyone who wants to be in the investment world should be reading, in Australia, the leading financial publication, or wherever they are in the world. They should follow podcasts. They should listen to successful investors. Any individual investment they make, they should read as much as they can on it, and look for the nuances, look for the changing languages, look for points that might give them a hint on when to buy more, or indeed when to exit.
That's great advice. And you're absolutely right that most of the greatest investors are voracious readers. They're always very curious and trying to learn. So you mentioned earlier on in our chat that when you started out with just over $1 million, you never thought you'd get to where you are today. How important has luck been as a part of your success?
Oh, luck is a very interesting topic. There is a cliche that says you make your own luck. I tend to believe in that. And what does that mean? It means doing what I've said, reading a lot, working hard. Something goes wrong, work harder, focus, be unrelenting in your pursuit of knowledge in relation to the investment you're making, set a high standard. And I think if you're engaging in dialogue on a number of levels, then you'll see the opportunities as they emerge. So you make your own luck by being exposed to more. You make your own luck by knowing more than the next investor because you've read more or you've spoken to more people. So you can't control external events such as the global financial crisis or a war that may erupt, but you can prepare your portfolio and your cash balances or your borrowing capacity such that when an event occurs, you're ready to participate in the market. Everyone says you should be buying when other people are selling and vice versa. So I think if you learn from history and you'll see some of the patterns, you'll know that we pretty much go in cycles. So prepare yourself for when a cycle does come, even though you don't exactly know what the timing is. But if you prepare yourself, then you're in a position to take action. And suddenly everyone said, gee, you were really lucky that you were ready to go and buy property when the downturn happened, knowing that over time property will perform for you or a particular company. So I think you make your own luck, and then you have to, after you put yourself in that position, make sure that you're action focused. I believe action is better than inaction. And I think that's probably a final message that I can give to people. Put yourself in that position, and when it's time to press the go button, make sure you do, even if it's for a modest amount, and you can always add to it.
Some great recommendations there: preparation, persistence, and action. So with that, I'd like to thank you very much, Alex, for kindly spending some time with us and telling us a bit more about your story and what you do at Thorney. And we hope to hear more about you and Thorney over the coming months.
Thank you very much.
Thank you for listening to the i3 Insights podcast. For more information, please visit our website at www.i3-invest.com. Thank you.